Ladies and gentlemen, good day and welcome to HDFC Limited's Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. We have with us HDFC's Vice Chairman and CEO, Mr. K.K.M. Mistry, Managing Director, Ms. Renu Sood Karnad, Executive Director, Mr. V.S. Rangan, Member of Executive Management and Chief Investor Relations Officer, Mr. Conrad D'Souza, and General Manager, Ms. Anjali Tarapore. I now hand the conference over to Mr. K.K.M. Mistry. Thank you, and over to you, sir.
Well, thank you very much, and good afternoon, everyone. At the outset, I would like to welcome all of HDFC's earnings call for the first quarter of the current financial year. The Board of Directors at its meeting held earlier today approved the financial results for the quarter ended June 30th, 2022, which were subjected to a limited review. Let me start with outlining a few developments in the economy over the last 3 months which have a bearing on the corporation. The Monetary Committee at its meetings held in May 2022 and June 2022 respectively increased the policy repo rate by an aggregate of 90 basis points. This was mainly on account of the uncertainty in the inflation trajectory. As a result, there has been an uptick in interest rates, consequent to which we have increased deposit rates as well as rates on our loan products. As we will discuss later, the interest rate actions have had a short-term impact on both net interest income and net interest margin during the first quarter. In July 2022, the RBI increased the limit of external commercial borrowing under the automatic route from $750 million to $1.5 billion each year. We are in the process of raising funds under this window of about $1.1 billion. The momentum in the economy was extremely strong throughout the quarter and is reflected in a pickup in individual loan disbursements and a 19% growth in the individual loan book, which is the highest growth that we have achieved in the last 32 quarters. Similarly, collection efficiency has continued to improve month after month, with over 99% collection efficiency on a cumulative basis during the quarter. Over the next few minutes, I will give you a summary of the key highlights of the performance for the quarter. Let me start by quickly summarizing the progress of our business throughout the quarter. Our individual loan approvals for the quarter in June 30th, 2022 were higher by 60% compared to the corresponding quarter in the previous year. For the quarter ended June 30th, 2022, individual loan disbursements grew by 66% over the corresponding quarter in the previous year. Disbursements in quarter 1 were the highest ever disbursements in the first quarter of any financial year and were over 60% higher than the previous best. Housing disbursements constituted 93% of individual disbursements in the first quarter of financial year 23. Growth in home loans was seen in the affordable housing segment as well as in the middle and high income groups. 92% of new loan applications were received through the digital channel. During the first quarter, we sold individual loans aggregating to rupees 9,533 crores. The individual loans sold during the last 12 months amounted to rupees 32,499 crores. These loans were all assigned to HDFC Bank pursuant to the mortgage sharing agreement with the bank. Individual loan book growth on an AUM basis was 19%. If the loans amounting to rupees 32,499 crores had not been sold during the preceding 12 months, then the growth in the individual loan book would have been 28%. This is the highest percentage growth in the individual loan AUM in nearly 8 years. Our individual loan book increased to rupees 4,47,402 crores, a growth of 19% over the previous year. In addition to this, the individual loans sold by the corporation and outstanding as on June 30, 2022 amounted to rupees 88,856 crores. HDFC continues to service these loans. Individual loans outstanding on an AUM basis amounted to rupees 5,36,258 crores. As of June 30, 2022, our non-individual loan book grew by 8% on an AUM basis compared to the previous year. We continue to have a reasonably healthy pipeline of non-individual business over the last 12 months. We have also seen some repayments and prepayments of earlier facilities and resolution of some stressed assets, and this has resulted in a lower growth in the non-individual segment. We currently have a good pipeline of construction finance loans as well as in the lease rental discounting segment, and we expect non-individual AUM growth to accelerate in the coming quarters. The overall loan book is now rupees 5,81,040 crores, a growth of 16%. The total assets under management as of June 30, 2022 amounted to rupees 6,71,364 crores as compared to rupees 5,74,136 crores in the previous year, a growth of 17%. If no loans had been sold during the preceding 12 months, then the growth in the total loan book would have been 23%. Prepayment on retail loans on an annualized basis amounted to 10.2% of the opening loan book. This is within the normal range, which is between 10 and 12%. The average size of individual loans for the quarter ended June 30, 2022 stood at rupees 35.7 lakhs as compared to rupees 33.1 lakhs in FY23. The contribution in value terms from the higher income group, defined as customers with an annual family income of rupees 18 lakhs or more, has increased during the year to 50% from 45% during the corresponding period in the previous year. Our trust on affordable housing loans continued. During the quarter ended June 30, 2022, 23% of home loans approved in terms of number of customers and 10% in value terms were to customers from the economically weaker section and the lower income group. The average home loan to customers in the economically weaker segment amounted to rupees 11.1 lakh, and to customers in the lower income group segment amounted to rupees 19.7 lakhs. If we break up the loan book outstanding on 30th June 2022 on an AUM basis into different categories, then individual loans constituted 79% of the total loan book, the same as compared to the previous year. Construction finance constituted 9% of the total loan book. Lease rental discounting loans constituted 7% of the total loan book, while corporate loans constituted 5%. If you were to look at the incremental loan book growth, then for the quarter ended June 30, 2022, the entire growth is from individual loans. However, we expect the proportion of individual to non-individual AUM to normalize in the coming quarters. 97% of the loans were sourced through distribution channels. However, this is largely through HDFC Sales, a 100% subsidiary of HDFC Limited, as well as through HDFC Bank. HDFC Sales accounted for 50% of the loans sourced, while HDFC Bank accounted for 30%. Third-party DSAs accounted for 7%. Thus, 83% of HDFC's individual business was sourced directly or through our associates. The Emergency Credit Line Guarantee Scheme was extended to mitigate the economic distress caused by the COVID pandemic. Under ECLGS 1, 2, and 3, the corporation has approved an aggregate amount of rupees 217 crores, of which 80%, that is 1,764 crores, has been disbursed till June 30, 2022. Amounts disbursed under this facility are guaranteed by the central government. The Reserve Bank of India permitted a one-time restructuring of loans under emission for COVID-19 related stress. As of June 30, 2022, the outstanding loans under both OTR 1 and OTR2 together amount to rupees 4,410 crores, equivalent to 0.77% of the as compared to a peak of 1.4% in September 2021. 98% of the OTR loans are in the individual loan book. The overall collection efficiency for individual loans has continued to improve month after month and is now even better than during pre-COVID levels. The average collection efficiency for individual loans on a cumulative basis over the last quarter is over 99%. RBI had on November 12, 2021 issued guidelines on harmonizing NPAs across the financial system. Subsequently, RBI deferred the effective date of the applicability of plans to September 2022. The corporation, however, has continued to report NPAs for the quarter ended June 30, 2022 in accordance with the revised RBI circular of November 12, 2021. There has been a significant improvement in asset quality over the last 12 months. To facilitate comparison on a like-to-like basis, we have compared the non-performing assets based on the old method of computation, since in June 2021 it was the old method that was prevalent. As of June 30, 2022, calculated under these old norms, gross non-performing individual loans 0.75%, down from 1.37% in June 2021, which is a 62 basis points reduction or a 45% improvement in percentage terms. The overall gross non-performing loans stood at 1.61%, down from 2.24% in June of 2021. This amounts to 63 basis points reduction or a 28% improvement in percentage terms. Let me now come to non-performing loans calculated as per the revised RBI norm. As of June 30, 2022, calculated under the new norms, gross non-performing individual loans stood at 0.98%, down from 1.44% in December 2021. Similarly, gross non-performing non-individual loans stood at 4.44%, down from 5.04% in December 2021. December 2021 was the first quarter when we were required to report NPAs under the new norms brought in by RBI. As per the new regulatory norms, the gross non-performing loans as of June 30, 2022 stood at rupees 10,288 crores, equivalent to 1.78% of the loan portfolio, down from 2.32% in December 21, which is the time when we first reported the number. As of June 30, 2022, the corporation carried a provision of rupees 13,328 crores in the balance sheet. Under Ind AS accounting norms, both asset classification and provisioning have moved from the incurred loss model to the expected credit loss model for providing for future credit losses. Based on this model, the total exposure at defaults of rupees 5,79,988 crores is broken up as under: Stage 1 constitutes 93.5%, Stage 2 is 4.4%, and Stage 3 is 2.1%. We have seen a 2.7 percentage point reduction in the aggregate of Stage 2 and Stage 3 assets from 9.2% in June 2021 to 6.5% of the exposure at default as of June 2022. During the quarter, we have charged a profit and loss account with a sum of rupees 514 crores towards provisioning. The ECL to EAD coverage ratio for Stage 2 assets is 23% and for Stage 3 is 53%. The provisions carried as a percentage of the EAD amounted to 2.30%. Annualized credit costs for quarter 1 was 33 basis points compared to 50 basis points during quarter 1 in the previous year. As stated in our earlier earnings call, as asset quality related issues get resolved, we should over the next few quarters be in a position to further normalize the credit costs to pre-COVID levels. This in turn have a positive impact on the return on equity. We continue to hold all our investments in HDFC Bank, HDFC Life, HDFC Asset Management, and all other subsidiary and associate companies at the original cost of acquisition, which is the price we had paid while making those investments. These investments are not accounted for on a fair value basis. If we were to mark to market the listed investments as of June 30th, 2022, the unrealized gain, which is the difference between the market price on 30th June 2022 and carrying cost, would be as much as rupees 2,17,223 crores. This unrecognized gain is not part of our net worth, nor has it been considered in our capital adequacy calculation. Our capital adequacy ratio on June 30th, 2022 stood at 21.9%, of which Tier 1 capital is 21.4% and Tier 2 capital at 0.5%. The capital adequacy is well above the regulatory requirement. Dividend at rupees 30 per equity share of rupees 2 each for financial year 2022 was approved by the shareholders at the annual general meeting held on June 30th, 2022 and has been accounted for in the first quarter. At this stage, it is important to talk about the return on equity. Under the Ind AS accounting requirements, net worth includes certain items which do not form part of Tier 1 capital under the prudential regulations. These include Ind AS transition reserve, deferred tax liability on special reserve, fair value gains on investments through OCI, investments in subsidiaries and associates in excess of 10% of the net owned funds, and securitization gains recognized upfront in accordance with Ind AS requirement. These items aggregate to rupees 19,886 crores. Hence, Tier 1 capital is rupees 98,455 crores as against the reported net worth in June 2022 of rupees 1,18,341 crores. A more appropriate way of calculating the return on equity would therefore be on regulatory Tier 1 capital as against the conventional method of computing it on total net worth. Annualized return on equity based on Tier 1 capital for the quarter ended June 30th, 2022 is 15%. As of June 30th, 2022, the corporation's total borrowings amounted to rupees 5,17,452 crores. Term loans including external commercial borrowings of $1.6 billion equivalent and refinance from the National Housing Bank accounted for 26% of the borrowings. Market borrowings, that is NCDs and commercial paper, accounted for 41% of the borrowings. Deposits as at the quarter end amounted to rupees 1,70,823 crores and constitute 33% of the borrowings. Further to RBI increasing the limit of external commercial borrowing under the automatic route, the corporation is in the process of raising a 3-year external commercial borrowing for on-lending for affordable housing, and the facility will also align with some of the sustainable development goals. Further details will be intimated shortly, but the expected all-in cost on a fully hedged basis will be comparable with domestic borrowing rates for a similar tenor. Our immediate plan is to raise an amount of $1.1 billion. I will now move to the statement of profit and loss account. The first quarter has seen a somewhat volatile interest rate environment, and therefore some of the numbers of the current year are not very strictly comparable with the previous year. Firstly, as mentioned earlier, net interest income and net interest margin were temporarily impacted by the mid-month increase in rates in both May and June, and the transmission lag between the increase in borrowing costs and the increase in lending rates. I'll come to that in a minute. Secondly, as a result of volatile equity markets, the gain on fair value of investments through the profit and loss account was just rupees 8 crores in this quarter, and this compares to as much as rupees 402 crores in the first quarter of the previous year. Thirdly, the expense ratios are higher as we incurred expenses upfront on staffing, loan processing, and branching to meet the significant increase in demand for housing loans. There was also an increase in legal expenses during the quarter as we saw an increase in business as well as resolution of some stressed assets. Needless to add, whilst these expenses have been incurred upfront, the benefit of the expenses incurred will accrue over the next few quarters. On the positive side, it is important to note that credit costs are lower than the credit costs in the corresponding quarter in the previous year as a result of improved asset quality and higher collection efficiency. Dividend in the first quarter is higher than the first quarter of the previous year, primarily on account of dividend received from group companies. Dividend from HDFC Bank will be received in the second quarter. Before I get to the net interest income, let me detail issues which have had an impact on the net interest income. In the first quarter of financial year 2023, we have had rate actions which have had an immediate impact on borrowing costs, which in turn have not been simultaneous with the transmission of rates on the asset side. Secondly, in the first quarter of the year, there was a disruption in the business activity in the economy as a result of the second wave. As a result of ample liquidity in the system during quarter one of last year, the overnight interest rate swap, which is the OIS rate on which some swaps are benchmarked, de-linked from the reverse repo rate and was lower by up to 40 points during that quarter. This led to us benefiting from the lower swap rates, which resulted in an expansion in NIM to 3.7% during the first quarter of the previous year. At that stage itself, we had categorically indicated that this level of NIM was not sustainable. This delinking corrected in the latter half of last year. Thirdly, in May 2022, RBI increased the repo rate by 40 basis points, and there was a further increase of 50 basis points in the repo rate in June 2022, making it an aggregate of 90 basis points during the quarter. As you are aware, each individual loan has a quarterly reset mechanism and is based on the original month in which the loan is disbursed. Thus, in the event of any interest rate change in the entire loan portfolio reprices over a 3-month period, that is roughly 1/3 of the portfolio reprices each month. Thus, whilst we have had an immediate impact on borrowing cost, the lending portfolio will reprice over a quarter. This transmission lag has had a material impact on the NII growth for this quarter. We have passed on the increase in rates by increasing our PLRs by 90 basis points, but there was a short-term impact on NII growth during the quarter. This should be regularized over the next few months. We have since revised the reset norms for our incremental individual loans from a quarterly to a monthly cycle to reduce the impact of transmission of rate changes. This should minimize the risk of transmission in the event of any future rate hikes for new loans. Lastly, the proportion of the retail loan book has increased to 79% over the last 2 to 3 years. Net interest income purely on the basis of interest without taking cognizance of the profit on sale of loans during the quarter ended June 30th, 2022 amounted to rupees 4,447 crores compared to rupees 4,125 crores in the quarter of the previous year, a growth of 8%. If we adjust for the one-time impact of the transmission lag in passing on the rate hikes to the customers, as well as the impact of the swap benefits in the previous year, the NII growth would have been 16%, which is in line with the growth on the AUM. Net interest margin for the quarter ended June 30th, 2022 stood at 3.4%. The spread of loans over the cost of borrowing for the quarter ended June 30, 2022 was 2.25%. Individual loans carried a spread of 1.91% and the non-individual book 3.45%. The spread on loans during the first quarter of the previous year was 2.29%. Income earned from deployment of surplus funds in cash management schemes of mutual funds and government securities was much lower at rupees 39 crores as compared to rupees 124 crores in the first quarter of the previous year. This was largely due to average levels invested this year in liquid funds at about 3,900 crores as compared to rupees 15,500 crores in the corresponding period of the previous year. With introduction of the liquidity coverage ratio in December 2021, the corporation's liquidity is largely held in government securities. The government securities holding as of June 30, 2022 is around 36,000 crores. The average level of liquidity held during the quarter was rupees 40,000 crores as compared to rupees 38,000 crores in the first quarter of the previous year. There was a profit of rupees 184 crores on sale of investments during the first this year compared to rupees 263 crores in the first quarter of last year. This year's profit was on account of the corporation's 10% stake sale in HDFC Capital Advisors. The profit on sale of investments in the first quarter of the previous year was on account of divestment of a small part of our stake in HDFC Ergo and the entire stake in Good Host Spaces, which was an associate company. Dividend received during the quarter was rupees 687 crores compared to rupees 16 crores in the first quarter of last year. The dividend during the year was received predominantly from our group companies, namely HDFC Asset Management, HDFC Life, HDFC Sales, and HDFC Credila. Dividend from HDFC Bank was received in July 2022 and will be accounted for in quarter 2 of the current financial year. During the quarter ended June 30, 2022, for investments classified as fair value to profit and loss account, the net gain on fair value changes stood at only rupees 8 crores, much lower as compared to rupees 402 crores corresponding quarter of the previous year. This is largely on account of the volatility in the equity markets during the quarter. Under Ind AS accounting standards, the stock options granted to employees are measured at the fair value of the options on the date of grant. This fair value is accounted for as employee compensation cost over the vesting period of the options. Accordingly, employee benefit expenses for the quarter includes an amount of rupees 76 crores compared to rupees 146 crores during the first quarter of the previous year. The current year's charge includes an amount of rupees 18 crores pertaining to ESOPs granted in the first quarter. For the quarter ended June 30, 2022, the cost-income ratio stood at 9.5%. The cost-income ratio was higher during the quarter as a result of the increased retail business over the last 6 months, as well as the increase in the branch network to cope up with this higher volume. The benefit of these cost increases will be derived over the next few quarters. Increased legal costs also contributed to the increase in the cost-income ratio. We expect the cost-income ratio to remain in single digits for the year. For the quarter ended June 30, 2022, the standalone profit before tax was rupees 4,590 crores compared to rupees 3,905 crores in the first quarter of the previous year, a growth of 17.5%. Tax provision during the first quarter amounted to rupees 921 crores compared to rupees 904 crores in the first quarter of the previous year. The tax rate for the quarter was 20.1% compared to 23.1% in the corresponding quarter of last year. The tax rate is lower than the previous year as dividend earned from group companies is set off against dividend paid by the corporation and hence the dividend income is tax-free. The standalone profit after tax for the first quarter stood at rupees 3,669 crores compared to rupees 3,001 crores in the first quarter of the previous year, resulting in a growth of 22.3%. Pre-tax return on average assets was 2.9%. Post-tax return on average assets was 2.3%. The basic and diluted EPS on a face value of 2 rupees per share was rupees 20.2 and rupees 20.1 respectively. The consolidated profit before tax for the first quarter stood at rupees 6,544 crores as compared to rupees 6,295 crores last year. After providing rupees 970 crores for tax, quarter one last year was 984 crores, the consolidated profit after tax for the first quarter stood at rupees 5,574 crores as compared to rupees 5,311 crores. The profit attributable to the corporation was rupees 5,308 crores as compared to rupees 5,041 crores in the corresponding quarter. As of June 30th, 2022, the corporation had 3,766 employees. Those total assets per employee stood at rupees 169 crores per employee compared to rupees 164 crores in the corresponding period of the previous quarter. Annualized net profit per employee was rupees 3.9 crores compared to rupees 3.6 crores during the first quarter of the previous year. Let me spend a couple of minutes to give you an update on the merger. As you are aware, on April 4, 2022, the Board of Directors of HDFC Limited and HDFC Bank approved a composite scheme of amalgamation of HDFC with HDFC Bank, subject to requisite approvals from various regulatory and statutory authorities, respective shareholders and creditors. Upon the scheme becoming effective, subsidiaries associates of the corporation will become subsidiaries associates of HDFC Bank. HDFC Bank will then be 100% owned by public shareholders, and existing shareholders of HDFC will own 41% of HDFC Bank. Both the stock exchanges, NSE and BSE, Pension Fund Regulatory and Development Authority, and RBI have accorded no objection for the merger. The application has been made to the CCI, to the Competition Commission, and we are awaiting approvals. HDFC's distribution network spans 695 outlets, which include 214 offices of HDFC's wholly owned distribution company, HDFC Steel Limited. HDFC covers additional locations through its outreach program. We continue to engage deeply with all our stakeholders on ESG. Our disclosures and reports are on our website. The Business Responsibility and Sustainability Report was laid out by SEBI, which will be a mandatory requirement from financial year 23. On a voluntary basis, the corporation has prepared this report for financial year 2022, and the same is hosted on our website. The integrated report for the year ending March 2022 has also been released and is hosted on our website. For further information on ESG related queries, you may engage with our investor relations team, Anjali and Conrad. During the period, the corporation's corporate social responsibility activities focused primarily on COVID-19 relief, health sanitation, education and livelihoods. Additionally, our support for the specially able cut across all our focus areas. CSR activities were conducted either directly or through the H.C. Parekh Foundation. The CSR spend during the quarter was rupees 75 crores. The above are some of the highlights of the results for the quarter ended June 30th, 2022. Before I conclude, I would like to wish you good health and all the very best. Please stay safe. We can now proceed to question and answers. I would request you to confine your questions to the financial results and to introduce yourself and be brief with your questions. Thank you very much.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. First question is from the line of Suresh Ganapathy from Macquarie Capital. Please go ahead.
Yeah, hi KK. I just had a question on this life insurance stake increase. Now, what is the logic of going up just by 1%? I understand HDFC Life just wanted 2,000 crores, but can you not take it to 50%, or have you discussed with RBI that you can take it to 50? Just some contours of the deal would be great.
All right, so I'll tell you quickly. The HDFC Life's solvency ratio had come down to about 176% as a result of the merger with Exide Life. Consequent to that, it was necessary for them to raise additional capital, and therefore the idea was to take the solvency ratio to about 210%, and this 2,000 crores will take it up to 210%.
Yeah, but then, is there any communication from the RBI? Can you hold 50%? Why can't you put another 1% and take it to 50%? Because it then really doesn't, face you a problem of asking for reduction of the stake, right? Or increase of the stake, sorry. If you were to do that. Yeah.
So Suresh, when we announced the merger, at that time we had said that we would like our stake in the insurance company to go up to over 50%.
Correct.
But for that, we are still awaiting the detailed guidelines on what the RBI would like us to do. So if we were to do any further stake increases, it would obviously be with the knowledge and comfort of RBI. This stake sale was necessary largely as a result of the reduction in the solvency ratio of HDFC Life.
Okay, fine. And this doesn't require any approval from any regulatory authorities, right?
We've obviously talked to the IRDA. We've already sent a letter to RBI, but this is more a regulatory requirement. So it was a regulatory requirement to increase the capital and promote a stake.
Okay, fine. Okay, that's clear. And the second aspect is on margins. Of course, it's come down a bit because of the interest rate resets and, of course, the increase in cost that you're talking about. But now, with the likely resets going to happen over the course of next coming quarters, can you see these margins inching up from the current 3.4% levels and have a better NII growth?
I would certainly expect the NI growth to go higher as the quarters progress. I mentioned that in my opening remarks also. The NI growth was impacted largely because of specific events which happened during the quarter. And if you adjust for the transmission time lag and the higher base in the previous year, then the actual growth in the NI would have been 16%. Conrad can review those calculations, 16%, which is in line with the growth in the AUM. So we would certainly expect the NI numbers to normalize in the coming quarters.
And what about the non-individual? Sorry, go ahead, JP. Sorry.
NI goes up, then logically even the net interest margin should show some improvement, should show some increase.
Okay.
Historically, as you would be aware, a net interest margin in earlier years used to be in the 3.3 to 3.4% range.
Okay. And the final question on the non-individual book growth, of course, it's gone up from a 9% decline about a year ago to an 8% growth. With the pipeline and everything which is there, which you talked about, you guys are okay driving this growth, say, to double digits, of course, not specific guidance that we're asking for, but you're confident of driving this growth even ahead of the merger?
I would expect the growth numbers to go up. It's been a little low in this first quarter. If you actually see the absolute amount of non-individual loans is lower by about 3,000 crores compared to where we were in March. That is because of resolution to cases and also because of scheduled repayments which have happened in a few cases. But yes, we have a decent pipeline. We would certainly expect this number to rise. I would say a double-digit growth is something which is very much on the cards as the year progresses.
Thanks, Keki.
Thank you. Next question is from the line of Mahrukh Adjania from Edelweiss Financial Service. Please go ahead.
Yeah, hi. My first question is, could you please quantify the disbursements during the quarter?
42,000. The disbursements during the quarter were a little over 42,000. 42,000.
Individual?
Individuals, yes. Individuals.
Okay. Got it. And the quantum of GSEC, so I heard liquidity was 40,000 crore, but the quantum of GSEC would be what?
GSEC was about 36,000 crores, roughly, on an average.
Okay, got it. And I just had a question on the merger. So basically, when the merger happens, how much of HDFC's book does not qualify for a bank's book?
Not very significant at all. Almost everything that we do is something the bank can also do. There may be just one or two small we do, like, for example, if there is a loan against shares or something like that, then that would not qualify in the bank. But that for us is a very, very, very small amount.
Okay. So it'll be like less than 1 to 2% of the total
Yeah,
loans, or?
I would think it will be less. Yeah, I think it will be less than 1 to 2%.
Okay. Thanks a lot. Thank you.
Thank you. Participants, you may press star and one to ask a question. Next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. So now, firstly, with respect to this repricing, just taking the question forward. So in terms of the rates, it's fair to assume that we would have also passed on 90 odd basis points, looking at the increase which has been there.
I mentioned that whatever has been the rate increase by RBI has been fully passed on to consumers. But the effect of those rates comes through over a period of 3 months, as you are aware in the agreement.
True. So this, when we have to fairly look at it in terms of the repricing, okay, because I think on the non-individual side, we have already increased the rates earlier as well. So if I have to look on the overall pool, okay, how much would get repriced over maybe a month? Maybe you said like you have moved it to monthly reset as well to benefit, say, from this transmission. So how much of the overall book would get repriced? And would it be fair to assume that on the borrowing side, given the way MCLR hikes have been, and for particularly for our deposit hikes have been, that would be relatively lower than the rates which we have increased on the lending side?
Well, first of all, the rates that we have increased on the lending side is equivalent to the increase in the interest rates in the system by RBI. We've increased our we call it retail prime lending rate. We've increased that by 90 basis.
Yeah.
Now, when we increase the rate, the customer's rate gets repriced every 3 months. You must be aware of that. So it's not that supposing we reprice the loan, let's say in the month of June, and a customer had taken a loan, let's say in the month of, hypothetically, in the month of May, then his loan will only get reset 3 months from May, which means it will get reset in August. So even though we would have increased the interest rates in June, this particular customer's loan will get reset in August. So to answer your question, 100% of the book will get repriced over a period of 3 months. Now, incrementally going forward for new loans, what we've done is we have reduced the period from 3 months to 1 month.
Okay, so that's only on the incremental loans. Got it. Okay.
Yes.
And fair to assume that the borrowing side increase would be relatively lower, apart from the maybe the bond market borrowing. But if I have to look at it on the bank borrowing and the deposits.
See, over a period of time, interest rates have been so volatile that for me to give you a number on where interest rates are, it just changes literally every second or third day. Because with the Fed now raising rates by 75 basis points, as you know, bond markets have rallied and there has been a general, belief that hikes will not be as significant as they were earlier expected. So a combination of all of this is that it's a little difficult to sort of predict where the interest rate rises would sort of end up. But yes, you are logically right. Deposits, whilst we've increased rates, the rate might be almost similar or a little less than the rate, the increase on the lending side.
Okay. And on restructuring, so restructuring book still seems to be flat. So just wanted to understand, is it like the regular, because you mentioned 98% is also individual within this. So are there repayments which are coming through? But somehow I think it was like last quarter also it was 0.8, this quarter it is 0.77. And when do we see the repayments coming through for this entire restructured loan?
No, one second. So Kunal, to make you understand, repayments are coming every day.
Normal installment payments will be coming through, yeah.
But what is happening is that the 0.8 will come to a lower number as the loan gets fully paid off. So loan is not necessarily going to get fully paid off. Unless it gets prepaid, that number would not necessarily come down, even though the payments are on track. So when I talk of this 99% plus collection efficiency on a cumulative basis, it obviously takes into account all the restructured loans.
Yeah, no, on principal moratorium, so once that's over, you will get some payment towards the principal as well, and we should see that proportion coming down, yeah?
So Kunal, we do report it, and I think if you look at the March numbers, and I think again it will be there in the September results, you will see what proportion of this portfolio has slipped into NPA. But the number is very, very low. So which means money is coming as per the restructured payment plan.
And also the borrower is making the payment for the EMI. The borrower is paying an EMI, an equated monthly installment, which has a principal component.
Yeah, sure. Yeah, so that's maybe the question was maybe when should we actually see it coming off a bit. No worries, I'll take it offline from Conrad as well. And couple of data points. So one is now, where do we stand in terms of LCR?
We are at 71%.
71.
We are at 71%. We are at 71%. The regulatory requirement, however, is lesser. The regulatory requirement at this point of time stands at 60%. So we are about 11% higher than what is required by regulation.
And last quarter it was 80.
Last quarter was...
Kunal, this percentage changes on a daily basis depending on maturities. It's a rolling 30 days. So it will never be a static number, but the average for this quarter has been 71. On certain days it could be 80%. The 80 which was reported would have been the number as of 31st of March.
Got it. Okay. And any write-offs during the quarter? Quantum of write-offs?
I mean, there will be some usual write-offs which would have happened. I think it's about 400 odd crores which we've done.
So normal
write-offs which we've done also for from a prudential sort of standpoint.
Sure. Okay. Thanks.
Thank you. Next question is from the line of Anand Bhavnani from White Oak Capital. Please go ahead. Anand, may I request to unmute your line?
Thank you. Thank you for the opportunity. Two questions from my end. One is in the opening remarks, you had given a number that about 30% of the loans were sourced from associates. So can you give us a sense of how many distinct branches of the 500 odd branches that HDFC Bank has would have contributed to the loan origination?
HDFC Bank accounted for 30% of the business that was done in this period. They have about 6,500 branches as of March, and they would be sourcing loans at the moment from less than 2,000 branches. I wouldn't have the exact number, but I would say it's closer to about 1,800 or something in that range.
So historically, what have been the reasons that we have not used the full extent of their on-ground presence?
Reasons which we talked about in the past also when we talked about the merger, which you may be aware of. We had said that we would like to do loans only from locations where we have a nearby HDFC office, because at the end of the day, the credit appraisal, the legal processes, the technical processes all have to be seen by HDFC. So that's why we did not source loans from other locations. Also, in a way, we want to sort of keep some sort of a limit on the total amount of business that just the bank could generate. But now, after the merger is completed, there would obviously be no such requirement, and period of time, the entire 6,500 plus branches of the bank would start sourcing housing loans for us. Also, I think HDFC Bank has put it on record that they have about 68 million customers, and out of 68 million customers, just about 8% have taken housing loans. And only 2% have taken housing loans from HDFC. So therefore, there is the ability to sell to this vast pool of customers who have not taken loans.
Noted. Second, sir, is an accounting query. I see there is other comprehensive income. Can you give us some color on that? It's quite a sizable number.
Rangan, you want to answer that? It would be largely the mark-to-market investments. So there would have been some appreciation in the value of probably Bandhan Bank or something like that, which would have contributed to the higher other comprehensive.
No, sir, it's negative figure actually. It's 469 negative. So
so it would contribute to the lower other comprehensive income. This is a figure which is not in our control. It is market determined. So most investments, other than the investment in things like RBL Bank or our investment in CAMS, Most of our other investments are through the OCI route. So market price of shares will go up and down quarter by quarter. Some quarters may be higher, some quarters may be lower. So this is only a reflection of that, nothing else.
Sure.
It's market price related. You will also see that there are certain investments like CAMS and RBL Bank where we take the mark-to-market gain or loss to the profit and loss account. And there, as I mentioned earlier, against a gain of over 400 crores last year's first quarter, this year's gain has been only 8 crores. And this is because of the obviously that you see in equity markets. Now, next quarter, this number could be higher or lower, we don't know. Based on the way markets have been over the last few days, if that trend continues, obviously it will be a lot higher.
Sure. And sir, in terms of preparation for merger, any color that you can give us?
I've already updated you on the process that was followed and the approvals that there's competition commission we've applied. We hope to get the approval soon.
Noted. And in terms of operations, currently, have you changed anything on ground operations?
At the moment, nothing. We continue to do business as well.
Sure. Thank you, sir. All the best.
A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. The 2 questions. First is, with respect to the merger, in preparation of the merger, do we plan to make any changes to our liability mix before the merger so that the transition is smoother? And if yes, what would be that be and how it will impact our cost of funds? And secondly, on HDFC Life, sir, is there any clarity that after the merger, how the regulator will look at our stake in HDFC Life, which is being less than 50%? And are there plans to increase the stake to more than 50%, which will take away the supply overhang, which the stock may have?
I had mentioned this in response to a question which I think Suresh Ganpati had asked, that why don't we increase our stake to 50%? The reason is that today the 2,000 crores of capital we put into the insurance, or we plan to put into the insurance company, is largely a result of the fact that from a regulatory standpoint, their solvency margin has come down, and we would like that number to go up to over 200, closer to 210%, which is why we are putting in 2,000 crores. We have not yet got any confirmation from RBI regarding whether we can take our stake up to 50%, but that has always been our request.
Sure, but I think that you have to take a stake more than 50%, right? Probably close to 50, 52.
Our request to RBI is to take it up toward 50%. We had mentioned this when the call after the merger announcement.
Sure. And sir, any adjustment to the liability profile before the merger?
Very honestly, nothing significant. The mix of liabilities has broadly remained the same, whether you are looking at 31st March or you are looking at 30th June. Broadly, there would not be much change.
Sure. Thank you, sir. That's it from my side.
But as I said, we are looking at this external commercial borrowing of 1.1 billion, which was not there in the last couple of years, because last 2 years, because of COVID, there was no way to access the international market. So that has nothing to do with the merger. That's nothing to do with the merger.
Thank you. Next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi. Thanks for taking my question. This question is on your, the ECL coverage on stage 1 and stage 2 loans. You're still north of 1%, well above 1%. I think it's almost 3-4 quarters now that, the real estate cycle has turned around. So somewhere we have much more comfort on what's happening to the asset quality or what can happen to the asset quality year on. So, when would you kind of, either release some of these provisions or probably write off some of the loans which, where do you think that there is going to be genuine stress?
So it's something we keep reviewing all the time, but we would always like to have a provision level which is higher than what is by regulation. But having said that, as I mentioned earlier, The credit cost, which is effectively your charge to the P&L account plus the write-offs, has come down from about 50 basis points in the first quarter of last year on an annualized basis to about 33 basis points in the first quarter of the current year. But this 33 and 50, you must understand, is annualized.
Sure. Thank you.
Thank you. Next question is from the line of Adarsh from CLSA. Please go ahead.
Hi, sir. Congrats on good numbers. So this is a follow-up on that liability question. Just thinking, while the things have been static in the last few months, as you get more and more regulatory approvals in certain of the merger, would you intend to increase the duration of some of the borrowings, given that the merged entity, the bank, would really, even if there is a grandfathering, it just relieves the pressure. So I'm just trying to understand that as you get into the merger for the next 12, 18 months, will you aim to increase duration, and that could cost money because longer dated paper would cost more money?
Yeah, but you must also understand, Adarsh, that even when you raise long-term money, you swap it into short-term rates. You swap it into current rates because all our loans are floating rate loans. So whether you're doing 10-year borrowing or you're doing theoretically 1-year borrowing, your floating rate cost is not going to be very different. But yes, there would be a conscious attempt to try and see if we can increase the duration of assets as we move, our liabilities as we move into a banking structure. But obviously, it has to be something which has to make sense. Rangan, if you're there, can you add anything? All right, let's carry on.
Yeah, sir. So I understand the swap part. So you're saying that most likely it should not affect margins in the interim period because you'll swap it.
No, it would not. It would not. I mean, we don't need fixed rate funding for long term. We need floating rate funding. So whilst we can extend the duration of our loan, it would not add to an increase in the borrowing cost.
Perfect. No, so that's good enough. Thanks and all the best.
Thank you.
Thank you. Participants, remember star and 1 to ask a question. Next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, thank you for taking my questions. There's just two questions again, kind of going back to the transmission thing that you kind of explained, the transmission of higher borrowing costs by increasing lending rates. So if from what I understood, if it is right, from the back book, I mean, individual retail loans will kind of get repriced every 3 months. But on incremental lending, you have now kind of reduced the repricing frequency from 3 months to 1 month. So is the understanding right that...
No, one second. Let me clarify this, please. I said 3 months, yes, 3 months, but it's not that every borrower's loan will get repriced on any particular date. The repricing happens 3 months from the date that they taken the loan. So some people's loans will get repriced in May, some months will get repriced in June, some months will get repriced in July, and over a period of 3 months, the entire book gets repriced. And yes, now we have moved it incrementally, where we will do it on a monthly basis. So this works both ways. When interest rates go up, it increases your cost. When interest rates come down, it benefits you.
So that this, I mean, reduction from 3 months to 1 month, because it has been done only on the incremental lending, does it still kind of leave you open to that transmission lag, given that there are wide-ranging expectations of another 50 to 75 basis points increase in repo rates during the course of this fiscal year?
Yeah.
So on the back book?
The bulk of it has already happened. The 90 basis points rate increases happen in a very short period of time. Personally, I don't believe that you will see a similar kind of an increase in the coming quarter. It will be more sort of extended over a sort of a longer time frame. But technically, very technically speaking, you are right. Duration of housing loans is about 5 years. And if all incremental loans that would have been given from the date we have repriced, we've changed this rule, which is about 3 months ago, will get repriced immediately.
Abhijit, if I may just add, this, what KK has been mentioning, pertains to the retail loans. As far as the wholesale loans are concerned, they do get repriced on a monthly basis even today.
Sorry, I should have mentioned that.
Yes, yes. I think, yes, that's clear. Thank you so much. And second question that I had is, right now, when this, interest rates are rising and you are increasing the lending rates, is the first thing that we do is kind of try to extend the tenure of the loan, to the extent permissible. Maybe maximum tenure of 30 years, maximum age perhaps of 60 years for an individual. Is that the first thing that we do, or are we kind of also increasing the EMIs? And maybe a related question to this is, let's say if there is another 50 to 75 basis points increase in repo rates during the course of this year, and consequently if they are kind of passed on through an increase in your retail PLR, can it kind of lead to higher delinquencies maybe in the second half of the year?
I can give you, based on past experience, this is not the first time that we've seen sharp increases in interest rates. We have seen sharp increases in interest rates happen. 2013 was one example, and then there are many more where I can't really recall the year. What happens is, whilst the housing loan on an average has a term of about 12 or 13 years, 1-3, at the time of origination, the actual duration of a housing loan is about 5 years. So it never runs to the full 12 or 13 term as originally as is originally fixed. There are two reasons for that. One is all loans are amortizing loans. So the moment you get your loan, you start paying back an installment, and that installment has got a principal component. So with every passing month, the outstanding amount of the loan keeps declining. This is number one. Number two is the fact that people tend to prepay loans. I mentioned that in my opening remarks that we had about 10.2% of our loans prepaid ahead of schedule during the course of 10.2% is on an annualized basis, but 10.2% is the prepayments that we saw in the first quarter annualized. Now, these prepayments are not because there are full prepayments or someone refinancing these loans or anything of that sort. The bulk of these prepayments happen because people in India continue to remain reasonably debt averse. A lot of people come ahead of time and make a part prepayment of the loan to reduce the term of the loan or to reduce the amount of the loan or whatever. So it's a very common practice. So in this particular instance where we were changed, initially it would be a change in the term. So it would go up initially from say 5 years to say 5.5 years or whatever happens because of the 90 basis points increase. But in every single case, not without exception, the loan is looked at from certain parameters. If the increase in the term is such that we are uncomfortable, or if the increase in the term takes him beyond a certain age, then we will ask the customer to make the customer's EMI higher and get him to pay a higher amount. This is a trend which has been going on now for the last 25 years, and we've never seen any increase in PLs as a result of the term getting up. And
this is useful, and this is just a follow-up question here. Yeah, please go ahead.
Yeah, go ahead.
So, I had a follow-up question here. So, if we kind of increase the tenure, this tenure can be increased without taking explicit consent of the customer, right? This tenure can be extended to keep the EMI the same.
Yeah, all that is built into the agreement. But case by case, if we find that there is any discomfort we have, as I said earlier, because the term has gone higher or because, beyond our comfort or because of whatever reason or the age of the customer, then we would just automatically increase the EMI and the customer would pay a higher amount going forward.
Thank you. This is very, very useful, KP sir, and all the very best.
Thank you. Thank you so much. Thank you.
Thank you very much. And I'll hand the conference over to the management for closing comments.
So I don't really have any closing comments. I've already made all my comments. Only I would say is that the NI reduction or the lower growth in the NI was largely a function of the transmission lag. And as the year progresses, this transmission lag will start sort of reducing, and we would expect, and as I mentioned earlier, if we were to adjust for the transmission lag and we were to adjust for the higher NIM in the previous year because of the reasons I mentioned, delinking of the reverse repo rate, then the net interest income growth would have been 16%, which is in line with the loan book growth.
Thank you very much. On behalf of HDFC Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you. Thank you, everyone, and stay safe, stay in good health.
Thank you, sir.